Hello everyone, welcome to the 149th episode of me learning how to trade in Forex. So in the last episode we went through building a second tier portfolio. Basically, so you got your traditional or primary portfolio where you wait and monitor your growth over a long period of time. But instead of passively waiting for the money to grow, some investors choose to take a more active role by building a secondary portfolio of speculative shares. So this secondary portfolio involves selecting shares with very high prospects for growth, such as bagger stocks. And bagger stocks are investments with values that increase by several times their original price or their current price. So a two bagger stock is an asset that doubles in value. So this second tier portfolio carries a higher risk than traditional investing, and there's a possibility that these type of shares won't amount to much or anything at all. So for this reason, it should ideally make up a small percentage of your overall portfolio. So there's also some few points to consider when you're trying to build a second tier portfolio. So we've got some questions here. So what impact will this portfolio have on my ability to build wealth in the future? How much am I willing to put towards speculative investments? What type of investments am I looking for? Have you considered 3 points here? So companies, certain speculative sectors, companies with small and medium market capitalizations, a company listed in developing economies. What criteria would a company have to meet before I invested in it? So here you can consider the number of competitors in the markets, the legislation that impacts how the company does business, the product offering, its consumers, its fundamentals like the price to earnings ratio. If the company no longer met one or more of the original criteria after I bought it, what would I do? And by how much would the investment's price have to rise or fall before I sold it? Okay, and got some bits about momentum investing. Yeah, and then we've got some lesson summary that we went through as well. So now we're on to how to manage your investments. So, how to manage your investments. Date is the 28th. When is the right time to sell investments? It's a simple question with a sometimes complex answer, but in the end it comes down to how much growth is enough. Remember, you can only realize a profit or loss once you sell your holdings. In order to work out how much an asset has grown, you will need to take several factors into account, including how much you put up for it. Profit or loss is only realized when you sell your holdings. Some investments can be decades old and your portfolio could contain several assets at a time. This makes it impossible to remember how much each of them cost at the time you bought them. Over this period, you could have also taken several actions you won't easily remember. For example, maybe you sold some of your holdings in an underperforming stock. Perhaps you reinvested or even withdrew some dividends. Suddenly working out how much profitable an investment is becomes complex. In addition to your investment strategy, preferably one for each account, you should have a complete record of all your actions. So, one for each account. It's preferable to have one investment strategy for each account. Complete record of your actions. Write down a complete record of all your actions. So much like a not a trading diary, but a investment diary. Let's call it investment diary. Preferably one for each account. You should have a complete record of your actions. Luckily, most online brokers keep a log of all your interactions with your portfolio in your profile, so you can always refer back to your history for any information you need. But just write them down anyway for your own sake, Living off your investment. For some, investing in the markets offers an alternative or addition to traditional retirement funds. If your investment portfolio is your nest egg, you have to sell your assets for cash to fund your lifestyle. However, this has implications for your future's earnings and tax liability. That's why it's advisable to sell investments gradually. Advisable to sell investments gradually. It's advisable to sell your investments gradually. Drawdown is a term typically used in pension funds to describe the rate at which you withdraw funds from retirement savings. Drawdown. Typically used in pension funds to describe the rate which you withdraw funds from your retirement savings. In this case, we'll use it to mean selling parts of your portfolio over time to cover your living expenses. In this case, we'll use it to mean selling parts of your portfolio over time to cover your living expenses. Right, okay. Your drawdown rate is usually expressed as a percentage of your portfolio's total value. So, your selling rate basically. So, your selling rate of your portfolio over time to cover your living expenses is usually expressed as a percentage of your portfolio's total value. For example, if your portfolio is worth £400,000 and you need £40,000 per year to cover your costs, your drawdown rate is 10%. So that £400,000 is going to only will last 10 years then, basically, if you do £40,000 drawdown. A high drawdown rate will result in you running out of money, and if it's low enough, you'll have enough of your portfolio to continue growing your funds over time. Working out your ideal drawdown rate depends on two factors. Working out your ideal drawdown rate depends on two factors. Your portfolio growth rate and the rate of inflation. Safe drawdown rate is usually the amount of growth above inflation your portfolio had in the previous year. So a safe drawdown rate is usually the amount of growth above inflation your portfolio had in the previous year. For instance, if the rate of inflation was 3% or your portfolio grew by 2%, you could withdraw 2% of your wealth without making a dent in it. Your remaining money would continue to grow in value and earn dividends, but if your portfolio only grows by 3% and inflation is 3%, any amount you withdraw would make an impact. E.g., if the rate of inflation was 3% and your portfolio grew by 5%, you could withdraw 2% of your wealth without making a dent in it. Your remaining money would continue to grow and in value and earn dividends. However, if your portfolio only grew 3% and inflation is 3%, any amount you withdraw would make an impact. Okay, your portfolio is currently worth £1 million, up from £950,000 at the start of preceding year. You want to use some of it as your main source of funds next year whilst you're on sabbatical. Don't know what that means. You estimate that you'll need £35,000, and the rate of inflation last year was 3%. This represents a good drawdown rate. £35,000. So, what is percentage of 35,000 up 90? So that's 35 divided by 950 times by 100. 3.68%. 3.68%. And your inflation last year was 3%. Yeah, it's good. It's above 3%. Never mind. 35,000 is 3.5%. 0.5% higher than the rate of inflation. Since your portfolio grew by 5%, the safe amount to withdraw will be 2%, which is 20,000. Rate of inflation is 3% and your portfolio grew by 5%. Oh, so 5% is the 50,000. 50, 1, 2, 3 divided by a mil times by 100. So that's our 5%. Since you put group by, oh, and it's your growth by, oh right, okay, yeah. So growth by 5%, and the rate of inflation of 3%. Then you only allow 2% off that mil, which is 20,000, not 35,000. Right, okay. I see. What makes this especially tricky is that inflation isn't reflected in your portfolio. While you can see your money grow, you can only feel the impact of inflation when you withdraw and spend it. That's why it's important to account for it in your planning. So, however, inflation isn't accounted for, isn't reflected in your portfolio. You can only feel the impact of inflation when you withdraw and spend it. It's important to account for inflation in your planning. When you consider drawdown rates, it becomes easier to calculate how much growth is enough for you. When you consider drawdown rates, it becomes easier to calculate how much growth is enough for you. It becomes easier to calculate how much growth is enough for you. Okay, so selling to rebalance. If you're managing your own portfolio using a clear strategy, you might have to sell some shares in an investment that grew too much. This sounds like a good problem to have, and rebalancing is controversial for that reason. But if you want to maintain your initial risk profile, you may need to do this. Did you know a balanced investment portfolio normally includes a mix of assets with differing risk levels? For example, a high risk asset grows, meaning it now makes up a bigger percentage of your overall portfolio, then you will need to sell some of your holdings to ensure you maintain the best possible asset allocation for your risk profile. Remember, each transaction incurs a cost and sometimes a tax liability. Rebalancing should be done with a clear purpose. If you're managing your own portfolio using a clear strategy, you might have to sell some shares in an investment that grew too much. This sounds like a good problem to have, and rebalancing is controversial for that reason. But if you want to maintain your initial risk profile, you may need to do this. You may need to do this to maintain your initial risk profile. A balanced investment portfolio will normally include a mix of assets with different risk levels. So a balanced investment portfolio will normally include a mix of assets with differing risk levels. For example, if a high risk asset grows, meaning it now makes up a bigger percentage of your overall portfolio, then you need to sell some of your holdings to ensure you maintain the best possible asset allocation for your risk profile. Are the holdings the high risk ones or the low risk ones? Or does that depend on your risk profile? Maybe it does. Okay, so remember, each transaction incurs a cost and sometimes a tax liability. Rebalancing should be done with a clear purpose. So each transaction incurs a cost and sometimes tax liability. Therefore, rebalancing should be done with a clear purpose. Cutting your losses. No one goes into investment thinking it will depreciate, but it's an unfortunate reality of investing. Not every company makes it. Deciding to sell can be hard, especially if you had high hopes for your investments. But selling a loser or an asset that's devaluing could benefit your portfolio in the long run. Share prices don't typically depreciate in a straight line. They can fall, recover, fall further, recover a little, and keep doing that dance for years. Those small recoveries can give you false hope about an asset's future, but analysing the market or following expert analysis could help paint a clearer picture about its future. So, share prices don't typically depreciate in a straight line. Always remember that your investment portfolio is bigger than just one holding. Once an asset hits your exit price, sell and invest in one that has better prospects. Remember that your investment portfolio is bigger than just one holding. Once an asset hits your exit price, sell it and invest in an asset which has better prospects. Sell it, invest in an asset which has better prospects. So that's a summary. Keeping record of all your investments is a good way to assess how much they've grown over time. Should you decide to live off your investments, calculate your ideal drawdown rates to avoid impacting future growth. You may need to sell some overperforming assets in order to maintain your preferred risk level. If an asset depreciates to an undesirable price level, it may be best to cut your losses. Always analyze the market before making decisions about your portfolio. Always analyze the market before making any decisions about your portfolio. Cool. So, to the quiz. Which of the following is an advantage of investing in your home market? It does not introduce diversification. You have easier access to news that you'll have easier access to news that could affect your assets. It looks that one, I think. It's more lucrative. All of the above. Not all of the above. Which of the following is an advantage of investing overseas? It introduces diversification to your portfolio. Yep. ABC plc and XYZ Ltd are competitor laptop brands with an almost equal share of the market. Rate of production, and they generally have the same level of annual returns. In an effort to grow their businesses, ABC plc hires 500 more employees across the globe to increase output. A global pandemic strikes, forcing several people to work from home and thus increasing demand for laptops. All else equal, which company would be better investments? ABC plc. Fundamental analysis relies solely on charts, graphs, and price data to form conclusions about an asset. False, that's technical. Company X, a newly listed tech company, has experienced high levels of volatility since its initial public offering. John decides to try and profit from these price fluctuations. To get started, he looks at the company's price chart for the patterns before putting his money up. This is an example of technical analysis. You can diversify your portfolio by buying local and offshore, investing across different sectors, varying the financial instrument you buy and sell, all of the above. A second tier portfolio is used for long-term investments. False. Inflation rose by 4% in the last year. If your portfolio grew by 8% to £500,000 in the same periods, what's the maximum amount you can withdraw without hurting your wealth? So 4%, 8% minus 4%, 4%, that's 4%, 4% of 500,000, 0.04 times 500,000, 20,000. Why is it sometimes good to sell holdings that are performing very well? To rebalance your portfolio. Your drawdown rate should always be at the same level as inflation. False. A. Nice. Investing locally benefits you because you'll possibly have earlier access to breaking news that could affect your investment than you would with an overseas holding. Investing offshore helps with diversification because your money isn't tied up to one market. ABC plc is better prepared to deal with increased demand and will likely make more money during this period and possibly beyond. Fundamental analysis takes a holistic look at an asset using all the publicly available information, such as the financials of a company, to form conclusions about its future performance. Technical analysis involves looking at an asset's price data for clues on how it will move next. Fundamental analysis will need more in-depth analysis of the company before any conclusions are drawn. All of these actions can help diversify your portfolio, so yep. You generally use a second tier portfolio for short to medium term investments. The aim is to capitalize on shorter term price momentum rather than long term growth. You can withdraw 4% of your funds without making too big of an impact on your portfolio. 4% of 500,000 is 220,000. If the assets that's overperforming changes the amount of risk in your portfolio, you may want to sell parts of it to bring back down to a desirable level. This is called rebalancing. Overperforming changes the amount of risk. So does overperforming increase your risk then maybe? Because if it's overperforming, then would it increase the chance of it? No. If it's overperforming, how does that affect your risk level though? Does that increase or decrease your risk level? I was going to say something about price momentum, but that's not even in the right context, is it? So does it decrease your risk then? Because if you're overperforming, then the share price is going to do really well. So if the share price is doing really well, then you won't need to have a higher risk to get your profit target. I don't know. You ideally want your drawdown rate to be any amount above the rate of inflation, i.e. percentage of growth. Minus inflation equals ideal drawdown percentage. That way the growth rate of your portfolio is at least on par with inflation. Cool. That's done. So I think we've just done fine-tuning your investment strategy. How to manage your investments. Yep. So fine-tuning investments strategy is done. Building your own investment strategy. Let's see. Understanding the basics of the stock market is a great start to your investing journey, but it might not be enough to help you achieve your goals. Crafting a strategy is one of the most important steps investors should take before participating in the markets. A good strategy will give you clear ideas and guidelines on the best ways to manage your portfolio. It will also help you stay on course with your goals and improve areas that need attention. By the end of this course, you should understand the benefits of having a strategy, as well as how to create one of your own. Cool. Let's go. So what is an investment strategy? What is an investment strategy? An investment strategy is a plan you develop as you go along on your journey to grow your wealth. It serves as a guide for how you manage your investing. Investment strategy is a plan you develop as you go along on your journey to grow your wealth. Serves as a guide for how you'll manage your investing. Serves as a guide for how you manage your investing. There's no blueprint strategy that all investors use. Your goals and financial circumstances are unique, so a good plan should reflect and account for that. Your investment strategy should reflect your goals and financial circumstances. Your strategy is where you'll record important information about your investments and their performance. Well, that's not the right place to put. Your investment strategy should... You should record important information about your investments and their performance in your... You should record important information about your investments and their performance in your investment strategy. That does not sound right, but we'll go over this. It will guide any future decisions you make and keep track of your capital, goals and risk tolerances. It will guide any future decisions you make and keep track of your capital, goals and risk tolerances. There are some important questions you need to answer before you begin investing. In the previous course, you thought about how much money you need, and what investing will cost you. Now you should be thinking about forming a strategy. Ask yourself these questions before starting. Questions to answer before starting investing. What do you want to invest? Why do you want to invest? Why do you want to invest? Investing involves taking a risk. Stock markets have historically provided investors with greater returns than cash savings have, but investments can fall in value as well as rise. Because of this, you need to carefully consider your reason for investing and whether you can afford to take the risk and be prepared for all outcomes at the end of your journey. So basically, you need to be prepared for the fact that you can lose all your money, and yeah, you just need to be prepared for that, because that is a possibility. That's going to happen. So what should I write for this? Investing involves risk. Involves taking risk. Your investments can fall in value. Your investments can fall in value as well as rise. Your investments can fall in value as well as rise. Because of this, you need to carefully consider your reason for investing and whether you can afford to take the risk and be prepared for all outcomes at the end of your journey. You need to carefully consider your reason for investing and whether you can afford to take the risk and be prepared for all outcomes at the end. By when will you need your money? Will you need your money? As well as knowing why you're investing, you need to think about how long you want to commit your money for and when you need to cash it in. Think about how long you want to commit your money for and when you'll need to cash it in. Unlike saving money towards something tangible such as a holiday or deposit for a home, which most people aim to do in 3 years or less, investing requires a longer time commitment. Investing requires a longer time commitment. How much risk are you willing to take on? You willing to take on? Are you willing to put your money into high risk investments with the hopes of high returns? Or would you prefer something more stable with less risk of losing your capital and profits? This is one of the most important things to think about before investing. We'll discuss it later in this course. Ooh. How willing are you to put wait Would you rather put your money into high risk investments with the hopes of high returns, or would you rather put your money into low risk investments with less risk of losing your capital and profits? This is one of the most important things to think about before investing. This is one of the most important things to think about before investing. We'll discuss it later in this course. Important things to think about before investing. How much time can you dedicate to managing your portfolio? Can you dedicate to managing your portfolio? The economic landscape can change in a heartbeat due to social and political events. This means you have to regularly monitor your portfolio to ensure it's on track to reaching your profit targets. Thinking about how much time you have will help you decide whether you can manage your own portfolio or if you need someone else to do it for you. By managing your portfolio, what do they mean by managing? So, the economic landscape can change rapidly due to social and political events. This means you have to regularly monitor your portfolio to ensure it's on track to reaching your profit target. Thinking about how much time you have will help you decide whether you can manage your own portfolio or you need someone else to do it for you. Thinking about how much time you can spare will help you decide whether you can manage your own portfolio or if you'll need someone else to do it for you. Someone else to do it for you. Did you know you can build your own investment portfolio, or you can delegate this task to a fund manager, financial advisor or investment firm? Fund manager, financial advisor. Some brokers allow you to invest in ready-made portfolios, such as our IG Smart portfolios, where you simply choose one that aligns best with your goals. You can build your own portfolio, or you can delegate this task to a fund manager, financial advisor, or investment firm. Some brokers allow you to invest in ready-made portfolios, such as our IG Smart portfolios, where you simply choose one that aligns best with your goals. In the next lessons, we'll guide you through some more factors to consider to get you started on creating your strategy. So, lesson summary. An investment strategy helps you prepare for your wealth building journey. It should be unique to your financial perks, circumstances, goals, and risk profile. I forgot to add that in. Your goals, risk profile, and financial circumstances. Just as the financial markets and economy change, your portfolio will need to be adjusted as well. So just as the just as the financial markets change and financial markets and economy change, your portfolio will need to be adjusted as well. Your investment strategy needs careful consideration, including whether you can manage it yourself or need to employ a specialist. Okay, so I'm going to leave this episode here then. In the next video, we're going to carry on with the lessons in building your investment strategy with how to create your own strategy. So thank you all for watching, and I will see you guys in the next video. Bye bye.